Well guys, with the insane destruction we're seeing in valuations through stocks like Amazon, Teladoc, and Tesla, there's no doubt in my mind that we're living through a once-in-a-decade kind of stock market. I mean, think about it, if the world's most successful businesses can't impress Wall Street with even decent earnings, then what hope do us small-cap growth stock investors really have? Well, as I'll show you guys, even though most retail investors have lost all hope, there is indeed some good news still out there in the form of inflation data and market sentiment. So in this video, I'll go over exactly what that news is telling us, and at the end, I'll do a technical analysis of the major market indices to see if we're setting up to go even lower over the next few weeks. But before we get into it guys, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. Let's start things off by understanding the state of the stock market right now. As you can see today, although we are seeing some relaxation in Chinese tech names like Alibaba and XPeng Motors, my portfolio for the most part has still gotten absolutely destroyed over the past few weeks. As you guys can see right now, the Dow Jones and the S&P 500 are not officially in a bear market because they're only down around 10 to 13% off their all-time highs. However, the more growth-focused indices like the NASDAQ and the Russell 2000 or the IWM are indeed in a bear market right now, which are down on average around negative 22%. To put that into perspective, the fall 2018 crash, which occurred due to the trade war and the Federal Reserve, resulted in the NASDAQ being down around 23% at its very bottom. Whereas the S&P 500 and the Dow Jones also lingered right around that bear market territory, being down almost on average 20%. So the key takeaway here is that although the growth stock market has gotten destroyed, there's potentially a little bit more downside left on the S&P 500 and some of the more industrial and consumer defensive stocks in some of the bigger indices. But if you're a net buyer of growth stocks and small cap stocks, this data is very good because it shows you that you are getting a very good risk to reward by investing right now. But as you guys can see, for the S&P 500 at least, bear markets are a very rare occurrence. The last two bear markets we had were in 2020 and in 2009 during the global financial crisis. And if you do the math, the average bear market lasts around 290 days, which is equivalent to around 6 months. However, unlike what many people expected, there is actually some light at the end of the tunnel if you do some digging and understand the recession and GDP data that we received yesterday. As you can see, US GDP contracted by around 1.5% in the first quarter of 2022, which came well in below estimates of a growth of around 1.5%. Now, the reason why I find this to be a little bit comforting as an investor is because historically recessions have always been fantastic opportunities to buy stocks. And obviously the whole reason the stock market has corrected in the first place since the start of this year is in anticipation of a recession happening because of heightened inflation. And although we still have to wait and see what the GDP data for the second quarter is going to look like before we can actually call this a recession, every time we have had a recession over the past 100 years, it has always been a fantastic time to invest in the market. And I think that is the precise reason why the market did not immediately tank after this GDP data came out yesterday. However, this obviously does not take away from the fact that in the short term at least, the market is going to be extremely volatile, as we've seen through the action in stocks like Amazon, Google, and recently Teladoc. And to the surprise of many investors, this has put the NASDAQ on pace for its worst month since 2008. And this simply reiterates the fact that if you want to invest in stocks, right now is probably one of the best opportunities. Because guess what? Unlike 2008, we're not going through a global financial crisis, and consumer spending is actually extremely strong. And neither is unemployment at all-time highs. In fact, the labor market is so hot that the Fed has to take action on that to suppress it a little bit. And I can guarantee you that the Fed is going to try its best to not put this economy into a recession simply by raising interest rates. And one of the tools that's going to allow the Fed to potentially be a little bit more dovish with raising interest rates is going to be the core PCE inflation data. As you can see, the data came in at around 5.2%, which is below the 5.3% estimate that analysts had initially expected. And so what this tells me is that there's potentially a sign of potential inflection coming in inflation, which is going to be a massive catalyst for growth stocks. And I definitely think that if the month-over-month data starts to inflect over the next few months going into the summer, we could start seeing some relaxation in the stock market. However, it's not just macroeconomic factors that's going to potentially soften the blow of a recession that everybody expects to happen. One of the other big reasons might be the fact that consumer spending is still at a very strong pace, as seen through the earnings reports from Visa. Visa grew revenue by around 25% year over year, and they specifically guided for an even higher growth going into the second quarter. And so unlike the fears that many people try to price into the stock market saying that consumer spending might go down in 2022, which could lead us into a recession, Visa here is showing that the economy is still very hot. And although that might not be a good thing for inflation in the short term, over the medium and long term, this is a very good thing because it shows that the fundamentals for the stock market are extremely strong. Visa accounts for almost 40% of all credit card transactions in the entire world. And if people are spending more money, that is going to benefit almost 90% of all the companies in the S&P 500. And now that even the big dog stocks like Amazon, Google, and Facebook have pulled back significantly from their all-time highs, it shows that we could be going and have gone through probably the worst part of this correction. If we now move on over to conduct a technical analysis of the S&P 500, as you can see, ever since we peaked out at the start of the year, we have pulled back very fast, rallied, and pulled back once again. Now for me, that is a good sign because typically when corrections happen, they happen in an A, B, C kind of format. That's what happened in 2015 when we pulled back, rallied, and pulled back again before we rallied higher into the next bull phase. And that's also what happened at the end of 2018 when we pulled back, rallied, and then pulled back yet again before we ended up rallying once again. And even though it's not very obvious in the 2020 crash, we did pull back, have a little bit of a consolidation phase for 1 week, and then we had another crash before we ended up going higher. And as you can see, this 410 level on the S&P 500 has acted as a massive support over the past couple of months, especially when Ukraine was invaded by Russia on February 24th. And so although in the short term there is a little bit of pain, which is primarily just driven by options expirations and volatility, we could see a nice inflection back to the upside from these levels if we come down to 409. Whereas if we now move on over to the QQQ, which represents the NASDAQ, the story is a little bit more different because we are selling off more aggressively than the S&P 500. But this has always been the case every single time we've gone through a correction or even a bear market. But this does mean you're getting an even better deal on some of the more technology and growth focused stocks. Whereas on the Russell 2000 IWM index, things look a little bit more bleak as we're coming down to test this 185 level for the first time since 2020. However, we need to keep in mind that we are in a bear market in the Russell 2000, so chances are we are going to see a little bit more pain in the short term. But the good thing is that on the weekly time frame, we are getting very close to that 200-week moving average at 173. And the RSI is now trading at 34, which is the same levels that we were trading in the 2016 crash and the 2018 pullback. However, one of the good things is that the VIX is now above 30, which it rarely is. And every time it has visited this level, it's always been a great buy the dip opportunity, even though in the moment it looks like the stocks are just going to continue going down. And the craziest part is that all this fear in the market that we've experienced in April so far has come off of no material news because obviously the last Fed meeting we had was in March. And so what this really tells me is that the market is simply trying to look ahead and price in a recession that could happen as a result of the Fed. But as I showed you guys, the recession is already potentially starting to happen right now. And if we actually go into it in the second quarter, then the stock market could potentially start rallying back up before we even know it. And obviously we saw that happen through 2020 when the stock market was rallying throughout March, April, and May, even though the COVID cases were going higher. And that's primarily because the stock market is always trying to price in ahead of time and look forward. But anyways guys, make sure to drop me a thumbs up if you found some value from this video. Let me know down in the comment section below your guys' thoughts on some of the recent inflation and GDP data and whether or not a recession is really in the cards in the second quarter. But anyways guys, I hope you enjoyed this video and I'll catch you guys in the next one. Take care.